with credit card rates super high, even auto rates super high, student loans becoming due. These are very quality options to get yourself into a position where you free up cash flow, because you can at least, at the very least, extend the repayment terms compared to other debts.
But oftentimes the terms are also going to be cheaper as well.
Absolutely. I mean, way cheaper. Like maybe even half or less than the rates that you're paying on other debts right now. And you could choose to do interest only, so your obligation could be less. So it's really a...
Well, not to mention, on second mortgage and HELOCs as well, it's still tax deductible. You can write that off.
Right, exactly. Welcome to Loans Elevated, the podcast that brings you the latest industry news, expert interviews, and insightful discussions that will help you stay ahead in this dynamic market. I'm your host, Broch Lassig, and I've spent years in the trenches of the mortgage industry, helping individuals and businesses navigate the complex landscape of real estate financing.
I'm your co-host, TJ Heidenreich, and together we'll cover a wide range of topics, from business strategies that skyrocket your success to mindset and motivation that fuel your growth.
Okay, everybody, welcome back to another episode of Loans Elevated. We are super stoked.
Yeah, we got refreshed.
Yeah, we got refreshed. We feel way more legit. But today we're talking about something that's a follow-up from last episode, which was all about mastering your money. And
2 episodes ago.
Oh, 2 episodes. Yep. Oh, yeah, forgive me. My last episode, sorry. A couple episodes ago on mastering your money. And it was a budgeting tool that we shared. But then we got to thinking, man, we should have really shared some ideas on what to do if you're in financial trouble or what to prep for more than we did. So today we wanted to highlight second mortgages and home equity lines of credit. Tej, dive into kind of like what we're going to talk about today. We've got a few options, and let's start sharing the pros and cons.
So first, let's dive into when it does a HELOC or a second mortgage make sense. Because right now, if you've bought in the past year to 2 years, maybe that does not make sense. Maybe it's a cash out refinance.
Even the past, well, true, right, exactly. A cash out refi could make sense. Even
to leave a lower rate.
Right. The past year to 2 years, your rate's probably over 5.5%. But even if your rate's under that, even as far as like 3 point something percent, a cash out refi could possibly make sense.
Depending on what debts you have or that you're looking to pay off or what you're looking to do with the funds.
Exactly. Yeah. So that's a good differentiator.
Yeah, but a second mortgage or a HELOC would make sense if you have an extremely low interest rate on your first mortgage and you don't want to touch that interest rate. Then you want to start looking into a second mortgage and or a HELOC. Now, we've got a couple options here at Cross Country. We actually have an automated HELOC, home equity line of credit, which it's all done through AI. And you get your approval within 5 minutes. It's easy to fill out the application link, and you get your funds in as little as 5 days, is it?
Yeah, it's crazy. Like I legit had a client, this was probably a month or so ago. I had a client complete their application in the morning. They were signing with the notary online. It's an online notary signing process, doing that same evening. So that's crazy. And then they had funds within 5 days from there. It was like less than a week after they signed, they had their funds in their bank account, which is pretty powerful. So I think that is the option that's really good for somebody who wants an easy process and needs their money very quickly.
It's also a fixed rate, which is really rare on HELOCs.
And you've got options. You can go anywhere from like I think it's between a 5-year or a 10-year and a 30-year option. We generally, which we can talk to you about this, we generally recommend the longest repayment term and the lowest fees, but we can go over those details. But that one is really, really good. Everything's automated. There's no appraisal needed, so you're not going to have an appraiser coming to your house to inspect things, or there's really hardly any underwriting process. It's all basically done online through AI, like TJ said. And you can go to 85% loan to value. Ooh, and the cool thing is on this one is you can actually finance investment properties, which this is the only HELOC that we personally know of in the country that will allow an actual legit line of credit. Not some companies offer on an investment property, but it's capped at like $25,000 or something.
What I was going to say,
which is ridiculous.
You can get over $200,000 on.
You can get unlimited. Amounts up to. Yeah, I can't remember the amount. Like maybe up to $350,000. Capped by the loan to value ratio.
If you're watching this on YouTube, we'll put it on the screen how much the actual cap is.
The exact is, but that's a powerful option, especially for investment properties and for ease and simplicity. Now, diving into the next option is our in-house second mortgage, which is not a HELOC. So it's a fixed up to 30 years, again, fixed second mortgage, which means the difference is once you close on the second mortgage, you can't pay it down and then redraw the money back again in the future if you need it. On the HELOC, you can do that. But talk about why somebody would want to use the second in-house mortgage as opposed to the automated.
Yeah, the differences between the two is the automated one, you don't have to get an appraisal on the house. It's all done through the AI, so it's not always going to be the most accurate with what the value is in your house. It's going to stay pretty conservative. Well, if getting the most amount of funds is really important to you, then the second mortgage might be the best option, because there's actually going to be a legit appraisal that's done on the house, so we can see the true value of your property to get the most money out.
Mm-hmm. And that's the one disadvantage of that automated one is it is automated. And in Utah, we're a non-disclosure state.
Yeah.
So what that means is there's not a lot of data available for these automated systems to pull
other than like county records, which are just so off.
Exactly. But I have seen some, it's not to say it's always off, because I have seen some that are, honestly, I've seen some that are worth more than the person thinks that it might be worth. So it's hit or miss, but that in-house second mortgage would be for somebody that wants maximum value and maximum available cash. But that is not available for an investment property, just primary and second home. It is a 30-year fixed option. So if you feel like, hey, I know I only need this money for a certain period of time or for a certain one single thing that I'm spending the money on, as opposed to having a revolving availability of liquidity, that might be a better option just for simplicity and certainty in the payment.
Yep. And also that's going to be your standard turnaround times with obtaining a loan, anywhere from 2 to 4 weeks.
Yep.
On the second mortgage route.
So generally, just to summarize, we'd probably add you to the automated HELOC that we have first versus this second. The only time this second would come to play is if you have a unique income situation. We even have bank statement second mortgages. So you can qualify as a self-employed person who claims little to nothing on taxes. You can use your bank statements to qualify. So the times that we would use these in-house second mortgages that we do, which is more of a full-blown underwriting process, are if you need more value or if you need a better, more personal underwriting process for something unique. But if you've got a very easy, straightforward profile and value, getting the maximum amount is not that important. The automated one's going to be the best for sure. And these are important. The reason we're bringing this up back to the budgeting tactic is these are very, very quality solutions to consolidating debt with credit card rates super high, even auto rates super high, student loans becoming due. These are very quality options to get yourself into a position where you free up cash flow, because you can at least, at the very least, extend the repayment terms compared to other debts.
But oftentimes the terms are also going to be cheaper as well.
Absolutely. I mean, way cheaper. Like maybe even half or less than the rates that you're paying on other debts right now. And you could choose to do interest only, so your obligation could be less. So it's really a...
Well, not to mention, on second mortgage and HELOCs as well, it's still tax deductible. You can write that off. Right,
exactly. It becomes a tax deductible interest.
Which is not on your credit cards.
Exactly, or anything else. Yeah, exactly. Just mortgage debt. And there are some limitations to that, so you got to get with a tax accountant to be sure that you're doing things correctly. But it's a powerful way to free up cash flow, get home improvements done if you're planning on selling your house, and even tapping into this to go buy an investment property or anything else like that. But really powerful tools to keep your first mortgage in place, but still tap the equity you have in your homes, which can be significant.
Another question then, what if I want to renovate my house? Or
that is super cool. We have a brand new program that just came out. We're still learning about it because it literally just came out yesterday, but it's a renovation home equity line of credit. So it's similar to these other options we talked about, except for it allows you to go up to 125% loan to value on the existing value, which is capped by 90% loan to value on the as completed value of the home. So
after it's repaired or completed, the renovations, it needs to be 90%.
So we would get an appraisal based on today's value, and then we would see what the plans and specs are for the renovations, whether you're finishing the basement or remodeling the kitchen, or maybe even something more significant than that, doing an addition.
So the appraiser does not have to go back out again. It's based off the plans and specs.
Right.
Cool.
At least that's what we believe now. And that allows you to which this has been a gap in options for most people that want to do renovations, is they're like, man, I want to get a home equity line to do renovations, but I don't have enough equity to cover it. But when the renovations are done, I will have way more than enough equity to cover it. This program is specifically designed to help those people. get renovations. And honestly, that's a good strategy because lots of people are looking at the market now. Again, they have a good rate on their first mortgage, but they're like, we don't love our house. It's just not hitting all the check marks. This would be a way to renovate as opposed to selling and help you accommodate your family or your situation better with your current home without interrupting that first mortgage.
Yeah. Correct me if I'm wrong. This does have to, all the renovations have to be completed by a contractor, correct? There's no sweat equity that can be done?
Sweat equity and self-help is always challenging. And like I said, it's a brand new program. So there's a lot of details we need to investigate, but generally speaking, you've got to hire third-party contractors to do this. You got to get bids. It's got to be something legit. But if you are interested, we can look at your unique circumstance and get you specific details. But those are the three main options we see for second mortgages or home equity lines of credit that allow you to tap into your equity and your cash that's available for a multitude of reasons.
Yeah, sweet. Awesome. If you guys have questions on this or you want to run through your exact scenario, DM us, message us wherever on any platform. We'll reach out and get connected.
Awesome. Thanks, guys.
Thank you for tuning in. For more industry insights, follow us on all platforms at Loans Elevated.
And to get in touch with our team, call or text 801-713-4000 or visit loanselevated.com.